Victoria, I've heard you once showed up for a final exam and something happened. So I have a question for you before we get into the guts of this podcast. Knock, knock.
Who's there?
History.
History who?
Exactly what Victoria's teacher said in 1990 and then canceled the exam. So Victoria Tabler is SVP of Real Estate Lending at Star One Credit Union, where she spent last 14 years and is currently overseeing the full mortgage operations, origination, servicing, and compliance for about $11 billion institution. She's a veteran, 30 years credit union veteran, having cut her teeth as an underwriter at Stanford and First Tech before joining Star One, a nationally certified compliance officer and licensed real estate broker. That's impressive. She brings rare end-to-end fluency across credit operations and regulatory risk. So welcome aboard. Thanks for taking time to do this podcast with me. Yeah.
Absolutely.
The theme of today's podcast is relationship versus transactions, the blend that wins in digital lending applied to mortgage. Star One has a unique no loan officer model, which was very fascinating when we were discussing earlier. So Star One closes mortgages in 15 to 30 days with a lean team and no traditional loan officer sales force. I would like you, Victoria, to explain to your peer group how you've built this realtor and member relationship without that layer from the Salesforce layer, and what surprised you most as you were going through that process.
Well, in all honesty, this is how it started at Star One. It is tried and true model for us. And the focus of our organization was always a member service and value proposition. No additional overhead for heavy compensated sales team. Let's be honest, that's sometimes a challenge to bring the cost to the member of the product down. That's benefit the member in better rates, in better closing costs. Our products are simple, transparent, no junk fees, no origination fees, no risk-based pricing, no gimmicks, right? So it is attractive for both members and agents. And in all honesty, nurturing realtor relationship was not our priority during a long stretch of refinance boom, right? That was loans were just coming in, borrowers searching for the rates, self-serve, and come to us. Nevertheless, loyalty and trust, as you mentioned, is an excellent execution. And with that, to start with, we gained quite a bit referral business from our borrowers. Over 12% of our members have real estate loans with us. That's our member penetration. And it is very different from the rest of the industry when we're talking about 2 to 4% member penetration or customer penetration. So certainly competition was quite skeptical. When we started with purchase wave, right? Like, okay, that's when relationship and building relationship with realtors are critical. And it wasn't a surprise. It was a plan, right? That our processor and underwriter actually went out to the community, to agents community, and start building that relationship. Basically just sharing what we have to offer. And I think the fact that agents or borrowers talking to a decision maker, right? They value that opportunity. And ultimately, it's a very not much sales culture. It's a sharing, providing benefits. It's bragging about what we have to offer to the members, to the borrowers, and how we can help agents to make their clients happy. So once they give us a chance, they keep coming and they spreading the word. Now, majority of our referrals still come from the members and borrowers, but big chunks, significant increase year over year. We start getting referrals from agents and realtor community.
I have two questions for you around this. The first one is it's a unique model, it has worked for Star One. But if I was to challenge you on a point, which is underwriters tend to be very attached to their computer and the documents they're processing, and they're very, intellectually very strong, right? Because they go through that training. Now, do you see a trade-off between members getting personalized service while also feeling that their interaction with Star One is efficient? So where is that balance between personalization and efficiency when you insert AI into the mortgage lending process. What are your thoughts on that?
Even since our previous conversation, more we look at AI capability in that space with the different partners and mortgage providers and technology providers. I think we're more excited about it. I personally more excited about it. We're not looking at AI as the decision maker, not in lending, but what we look to AI is as most efficient assistant, right? It's just help us to deploy efficiency, automation for like routine workflows. I mean, let's be honest, there's so many boxes to check, so many pieces of paper to validate, and that could be absolutely given to AI, where it will provide us with ability to make more informed and faster decisions and provide our staff ability to truly develop relationship, guide our members, have a personal touch in those critical transactions, while AI doing the mundane, I wouldn't say simple work because it's not that simple,
It's not that
but
simple.
but it takes a lot of our staff time. And so validating documentation, finding the red flags, right? It would be so much faster than human eye could do and allow our staff to truly build relationship, to have a human touch and connect with our members, truly build those relationships, right? Allow them a little bit more time on the phone if necessary, allow
Yep.
them a little bit more guidance, financial guidance maybe. And our member research we did, what are the things they're looking for? They do look for guidance. They look from professionals and from financial institutions who they trust. And if they come to get a mortgage from us, they certainly trust us. So that will provide us more opportunity to highlight maybe other services which beneficial to us. And it's true to our mission. So I'm actually very excited to integrate AI in our processes and how we're planning to integrate it. I'm like ready to get there.
That's awesome. And one thing that we have learned, some of it is industry knowledge, some of it is our knowledge working with clients, is the guardrails are going to be critical here. And what I mean by that specifically is, let's say the prospective member submits a documentation, let's say around income, or it's around the paperwork for the house asset that is being purchased, and you are having the AI pull out different pieces of details and kind of tie it all in as you're building out the package, underwriting package. You could have situations where AI incorrectly pulls information out, or it because maybe somewhere there were handwritten notes in some parts and it's not able to correctly get that. So building sufficient quality checkpoints, even in a scripted AI workflow, is going to be super critical. And almost you almost have to run it as a pilot with X number of things and just, and have the human moderation, just like any production deployment. When you're deploying something new, you run the BAU for a while in parallel, and then you start to slowly take it off. So I think that process flow will still be important, knowing that mod is a highly regulated space of all the credit products, and the error margin is pretty low in that sense, or tolerance for
100%.
margin is very low, right? In that sense.
Oh my gosh, security is at most importance to any financial institutions. Look what happened in the world. Just even getting information out to the OpenAI or anything like that, that just having those guardrails are critical. And decision, right? Again, information in, information out.
Yeah.
There's
Yep.
not a lot of control, human control could be. So we are very careful about deploying any technology. We are
Yep.
excited what it can bring, pilot, careful, slow, and steady with all the validations. Absolutely, that's our approach. We not, I mean, technology is important, but it's only important when it's great, right? And the thing is, great technology, the good experience, digital experience, it is expected nowadays from the consumers,
Yes.
right? They expect the security, ease of use, and all that. So we certainly need to proof and check it back and forth and to make sure how we apply it to allow our staff or to allow human eye to validate, to check, and be comfortable when we're deploying things. Now,
Criticisms.
this
Very critical.
without even that heavy of technological use, we validate during the process. We validate accuracy prior to funding, post funding, and that is the whole another layer of the human touch that we need, right? And so, absolutely, we should be careful with that.
So I'll share a quick anecdote. It's a simple story, but illustrates the point. So I use an AI provider. Let's just say that I use an AI provider and have a lot of automation done. And one of the things I have it do is essentially analyze the financials of an institution. So if I'm talking to you, I'll have it analyze Star One's financials. Now, I was working with an example, Credit Union X. I had it analyze the financials. It did a pretty good job, even gave me a nuanced view. Somewhere halfway through that document, very easily and calmly, it said, well, off their $1 trillion credit card portfolio. I'm like, huh, what? $1 trillion credit card portfolio? And then it started to go very nicely and explain me how they got to 1 trillion and such. And this is an institution with overall about $7, $8 billion in assets. So the nuance here is that, and I was telling this to somebody else the other day, an AI will get maybe 8.5 correct, and you're looking for that 1.5, and that 1.5 at sometimes might be trivial, and it's like you have you have a smile and you move on. And in some cases, that 1.5 could be so critical for your decision making. And so your lens or your filter should be commensurate to where it could have the most. If it goes wrong here, it'll carry a lot of risk. In other places, I'll be fine. If they misspell somebody's name, I'm fine with that. But that whole 1 trillion versus 500 million was the number is very, it can be very jarring, right? It can create a lot of issues downstream internally in the underwriting process and even with regulators if not carefully managed, right? In that sense.
Absolutely. No, I mean, and in the good old days, we talk about trust but verify. Why it should be
Trust and verify.
different with technology.
Correct. Correct. And I think in this case, because you don't know where all it will fail, and so bottom line, the guardrails. I think the key messaging here is the guardrails, the quality control checkpoints. You could even have AI be your quality checkpoints. They call it, LLM in the loop, or LLM as a judge. You could have those, but those are as critical in the design of your AI architecture. That's as you're infusing AI into the overall workflow. Yeah.
Great message. I mean, going through quality control, I think when we started even quality control of our loans, and if you choose to pick the vendor, right, then you need to quality control your quality control. You need
Yes.
to make sure that the vendor is qualified to perform that quality control and pick and choose validation to make sure there's no errors in that. Absolutely. That's creates another layer where we
Yes.
need to make sure that it doesn't fail us.
I agree. Moving on to the third question. So you have a unique business model, which is quite skewed to the mortgage portfolio. You have a large fixed rate mortgage portfolio. And as the rate, we went from benign rate environments to high rate environments. So these loans, as they carry forward into your current portfolio from a yield perspective, you did a couple of things there to really protect yourself in a low fixed rate environment where the vintages for these loans that were mortgage loans that were originated. Could you tell us a little bit about that? And candidly, this question is not so much about just what you did there, but what is your advice to CLOs and CROs and CFOs of similar sized credit unions, which you are large today? How do you broadly manage net interest margin pressure, or broadly profitability pressures? If you have any thoughts on that to share in the community, that would be awesome.
You said it right. Star one, biggest risk and interest rate risk caused by mismatched duration of funding of long-term assets, right? Real estate loans with short-term deposits, our regular savings. We are portfolio lender. So hedging that risk has always been a part of our risk mitigating strategy. And first with FHLB bank with borrowings, and then later on with the swaps, right, to protect in a rate up scenario, because that is where our vulnerability could be. We ended up during COVID with a huge portfolio of low interest rate loans. And understanding that, right, we did the swap. It's like paying for insurance.
Yeah.
We cannot be greedy with the growth you have, and we did it at that time. So now when rates increased rapidly, that insurance paid off and helped us bolster our NIM in very difficult financial situation. And I guess my advice to CLOs would be not to work in a vacuum. It is like asset and liability. It's a bigger picture of a healthy and sound financial institution. Sometimes we looking at a growth and get excited about it, but really it needs to be sustainable growth, right? Asset liability management, it's a balance of the risks and reward. And so working together with your financial team, prepare for the rainy day while you are projecting for growth. I think a lot of times we put more attention projecting for growth. What are your projections? I mean, we talk about it all the time, where we're going to end up this year. But I think just as much attention needs to be put in
On the downside.
to offset risk scenarios, potential risk scenarios. We do that. We have asset liability committee. We do all those testing, your worst case scenario testing on a regular basis. I know it's required for the institution over 10 billion or over 15 billion. We start doing it much earlier. And so that certainly kind of create that balance, understanding, even learning it from the lending standpoint, right? We always want lower rates and bigger growth, but how it relates to at the end in a different environment, different rate environment, different market conditions. Sometimes it escapes us as we busy with managing growth. And so I think go outside that, look at the bigger picture, and working with your treasury department, with financial department, through asset liability committee, I think that is very critical.
Excellent answer. Last question for you. As you look out 2 years from now, so end of 28, what is one or two key things as initiatives that Star One is doing that you're most excited about? Or one?
Excited about a lot of things. I think we are continue to build the value for the member. I think the fight to get the loyal and trusting members are very critical. You want to attract younger generation. You want to stay in line with current times. So I think all our focus on technology and balance technology with a human touch.
Yeah.
I think that is one most important thing, to deliver value to our members in the way that they're ready to take it.
I'm going to just double click on that last point you said. We know there's a generational wealth transfer that is happening
Yes.
soon. It's already going through, but it'll accelerate. So, credit unions and broadly financial institutions are at this twin edge of you have to service members who are older, and at the same time, due to this generation wealth transfer, to make sure your liquidity does not leave your system, you have to service or provide services and capabilities to the younger generation where you are able to satisfy both needs at the same time, so that it's almost like a transition. Maybe 30 years from now we'll be having a different discussion, but at least for now there is a transition discussion going on, and you have two audiences. I know I'm simplifying the world here, but there are two cohorts of population that you have to make sure that you're providing excellent service, and they both have different mindsets of what excellent service could be, right? So it is a challenging transition, which credit unions and broadly the FS space has to get right if we want to if we want to have a successful generational transfer, right?
Yes, 100%. You said it better than I did, but that is our focus is because, but in fact, bigger portion of our members are older members, and we need to continue to service them as we have before. But it's also goes back to how we use AI and how we use technology, right? We use it as a support to the human touch because everything could be done faster and more accurate, mundane tasks. 1 hour staff, trained staff who we need to invest in can use both, because it's transition for our staff as well to use different tools. I don't know, Microsoft Pilot transition was challenging and exciting at the same time. And my gosh, how much time it saved us just to send a nice touching email, simple touch in the fraction of time, right? But here we're looking at how we're delivering payments solutions, how we're delivering applications. Even to join credit union needs to be easier online, but also at the branch. We see that actually more younger generation coming to the branch to set up their accounts. I mean, it's great, but I think at some point, few years back, we thought that branches already not needed, that everything could be online by small fintech. But we learning that it's not true. So I think it's just that whole change management for the team, for the staff, where we can address both, and we ourselves can transition to use technology as a tool so we can help different generations the best we can.
Yeah, and something popped in my head, and I'll just say it. For, let's say, somebody in the 20 to 30 age group today, a big element of being the first time home buyer is, literacy around the whole home lending process. Now, sure, today you have your frontline underwriter staff that is front facing, going and talking to the members, but that model could get somewhat upended, and I don't mean that in a bad way. But you could have virtual agent bots actually providing in an interactive chat session where they're knowledgeable within the guardrail set of being able to address questions on literacy around how do you go about your first home purchase. So that could be like, go talk to the bot and it's going to do a good job, and then come, and then those questions which need to be escalated because the virtual agent didn't do a good job coming, having a one-on-one session, that will obviously drive productivity of the agents. But all I'm trying to say is that you will probably see there's some areas of low-hanging fruit immediately where a Gen Z and so on and so forth would almost prefer to have a private 30-minute session with a virtual agent and then moving on to a human underwriter for the questions that were not addressed correctly, right? So those kind of models
Absolutely.
come in, right? So yeah.
Absolutely. And the thing is, the way you described underwriter frontline, they're guiding first time home buyers, that is who reach out to us, right?
Yeah.
That's not all. And so a lot of our information related to the mortgages, it's a lot of it is self-serve. It's more than most of the lenders. We have it on the website. We already have chatbots on the call center when those kind of questions can be responded to the member right away. And you're absolutely right. The thing is, younger generation or not younger, everybody now we realizing want to learn in different ways. Somebody
Yes.
wants to have a short video or cartoon. Somebody wants to ask the question and not be bothered, right? And somebody needs the person to call and explain it. And somebody needs to sit down at the branch and go through the paperwork. And so we're trying to address it. And again, with the help of technology, I think we can do most of it. And we have all information already. And with AI, even grabbing our information from our system, from our
That's right.
website, from our resources, and providing it to the borrowers in whichever form they like it,
Yep.
I think that is where we're going to go.
And you're right. I think ending this podcast on that point, that it's not, you're right. It's not necessarily about, clearly defined age groups wanting all digital or all human interaction. It's actually the mindset depending on what profile, what their background, what their earlier professions or current or earlier professions were, you will find people gravitating towards a branch or some blend or online. It just depends, right? So that's true.
Yeah. Our members originally, Star One came from Lockheed Martin Missile Defense, and
Mhm.
our members were rocket scientists.
Mhm.
And I'm not kidding you. They will review every single formula in the good faith estimate
Wow.
or the disclosure and question our staff, why does it not match? And so that's, I think, when original human touch came from, because we would have to be very familiar with every single page of that 100 document closing package
It's true.
to explain
It's
it
true.
to them. And that's how they liked it. So we put a lot of information, a lot of Q&As and a lot of training to
Interesting.
truly understand it. So then we now hopefully can deliver it in different format, because ultimately you need to meet your borrower where they at,
Correct.
whether you do it in person or virtually. How many of our kids now like all those I don't know, I'm not talking about TikToks or Reels, whichever. If they like to learn it that way, we better provide that information that way. And if somebody wants 100-page documents to go and read the small script and re-verify the formula, especially when the whole TRID came out and it became different, we were validating that formula with them on the phone and that's what they want. That's what we're going to do. And so that's how basically our model came about, because you want to get their attention and trust, you better understand what you're selling.
Now, that's awesome. But what that did, by the way, as you said that to me, is your knowledge assets got stress tested. That's awesome
Yeah.
because you've codified, documented all of this stuff. Doesn't matter if they're Word documents or what have you, but they're there. That gives you a leg up on a lot of other lenders in the sense of this, if correctly fed to the AI as it trains, you've got a really strong corpus of knowledge that you've created, right? As because you had borrowers who were very discerning on every aspect of it. So they were stress testing you and your team from a knowledge perspective, but that's given you an information edge in that sense because you have a lot of this information
Yeah, we
codified.
certainly, yeah, we certainly proved it with that, and it
Yes.
was challenging, I can tell you. Nevertheless, I think that's how we build our model around the challenging tasks.
Yeah.
It's just like people talk about thinking outside the box. Sometimes you need to get comfortable in the box, right? Okay, well, this is the heavily regulated mortgage process with bunch of documents and formulas, with some of them don't make a lot of sense. And you need to decipher it and figure out how to make your borrowers comfortable, your staff comfortable, your regulators comfortable with what you're providing. And so simplicity is the best solution for us. Tailoring it to the borrowers, how they wanted to be served, is
Yes.
important to us. And so that's how we operate it.
Yeah, those are your key elements of your secret sauce. Awesome. Thank
Mhm.
you, Victoria. This has been a fascinating discussion, and hopefully the audience will get a lot out of it from somebody like you who's a practicing underwriter and a real estate broker, and now having led the lending function for a long time. But these practical experiences and also as you look forward into what's exciting with AI, these are fun times and challenging times at the same time. So it was an awesome discussion. Thank you for coming on the podcast.
Thank you so much. I appreciate it.